This video will be the second of a three-part series covering various financial disclosure issues. In part 1, we covered related party transactions and subsequent events. In part 2, we will discuss reporting for diversified companies. Here we have the top of GE's 2019 income statement. GE is one of the most well-known diversified companies in the world, although in recent years the company's financial troubles have led to spin-offs that left the company less diversified than it once was. In the revenue section, you see the lines sales of goods and sales of services. All this tells you is that the company sells something and provides some service. If you were instead looking at the income statement of Apple, you'd have a good idea what went into these line items. Sales of goods would include iPhone, iPad, and Mac computer sales, while sales of services would include things like Apple Care services. However, with GE, it's less clear what makes up these numbers because of their diversification. This is why diversified companies are required to provide extra reporting to break these revenues down by segment. Let's take a look at an example. In this example, we'll be taking a look at the footnote for General Electric that has their segment reporting. So footnote 26 is operating segments, and I want you guys to just take a minute to pause the video and head over to the link that I've put on this spreadsheet. Normally, we'd play a fun little game where everybody kind of calls out different segments that they think GE might be involved in, but since we're not together, I've created this quiz instead. So pause the video, head over there, and try to guess what GE might be operating in, which segments they might have business in, and then come back and we will walk through the rest of this together. Okay, so usually when we play this in class, we have somebody who knows that GE does appliances, and honestly, I don't even know which business segment that's in. What GE does have a lot of is they have power and renewable energy, which are basically kind of the same thing. They're very similar. But then when you start trying to figure out, okay, well, what's similar to that, then you run out of answers very quickly. So instead, we just start kind of guessing random things. So usually somebody knows that they do aviation. Oops. And basically they make turbines, I think is what they do. And then we start guessing random operating segments, and we finally find healthcare. And then also we know that they have a financing wing, so that's what comes down here. So if you look at this, you see that they're kind of all over the place. They have power, they have aviation, they have healthcare, and they have capital. And so if you're trying to project how this company might do in the future, it would be helpful to know about all of those different industries as opposed to just trying to guess based on previous financial results. So as we saw in the example, diversified companies must disclose the results of their operations by reporting segment. Reporting segments are identified using whatever approach management uses when making decisions about the company. In the GE example, the reporting segments were based on products and services, or, more generally, industries. However, depending on the company and its composition, management could make decisions based on geography, legal entity, or customer type as well. So what is the purpose of segment disclosure? First, investors can better forecast future profits and cash flows. Thinking about GE again, as an investor, you might make different assumptions about the future profitability of the healthcare segment than you do about the aviation segment. Knowing that GE is involved in both of these industries and tailoring your assumptions to each should make forecasts more accurate. Similarly, the same logic can be applied to estimating the overall worth of a company and its assets. Finally, the absence of a segment disclosure puts non-diversified companies at a disadvantage. Say it's a bad year for the aviation segment, but such a good year for all of GE's other segments that they are very profitable. Without a segment disclosure, you might assume that GE figured out how to be profitable in all of their segments, including aviation, despite other companies in aviation faltering. With the segment disclosure, you can see that no, GE didn't do any better than the rest of the aviation industry, It was just that their diversification strategy paid off and made up for any losses therein. In other words, investors want these disclosures. There are some downsides to segment disclosures as well. First, investors need to be knowledgeable about more industries to avoid misinterpretation. Often, investors will specialize in an industry that they are knowledgeable about. By definition, investors would need to know about multiple industries to invest in a diversified company. Without segment disclosures, however, investors wouldn't even know which industries they needed to understand in order to improve their forecasts. So this argument goes hand in hand with number 5, which states investors shouldn't care about segments as long as the overall performance is good. It seems the argument that investors couldn't possibly understand all the complexities of these companies, so they should just trust management. Management also sometimes opposes segment disclosures because they don't want to provide that information in public where their competition can see it. A company may think that it has found the perfect diversification. Say, for example, healthcare always has good years when aviation has bad years, and vice versa. And they don't want anyone else to know about their secret sauce, that they've found this perfect diversification. Managers also like diversification because it allows them to take risks or make big investments in one segment, while the other segment is acting more conservatively. They worry that investors might not understand the long-term strategy and will penalize them for an underperforming segment despite overall profitability. Finally, we have some more practical concerns. Accounting at the segment level is not always meaningful because it can be difficult to divvy up centralized operations used by multiple segments, and preparing disclosures is just hard in general. Anytime we add a disclosure requirement, one complaint will be that it will require time and expense to comply. In other words, management would really prefer not to make segment disclosures. So since management lost on this one, and segment disclosures are required, we should learn how to do them. First, we need to identify all the operating segments. These are components of the business that generate distinct financial information and have their results reviewed regularly by the chief operating decision maker. Once we have identified all of the operating segments, we can combine any that are the same across the following attributes. They offer the same products or services, they produce them in the same way, provide them to the same types of customers, distribute them in the same way, and operate in the same regulatory environment. Once we have identified all the reporting segments, we need to determine which ones are large enough or material enough to warrant breaking out in the segment disclosures as opposed to being lumped together in an other segments category. A segment is considered material if it passes one or more of the 3 significance tests based on revenues, profit or loss, and identifiable assets. After identifying the significant segments, we need to make sure the sum of the revenues disclosed by those segments is greater than 75% of the total, and that we've obtained this coverage with 10 or fewer segments. Right, so if we fail one of the last 2 tests, we would need to go back and make sure we've identified our segments properly. The most likely scenario is that there are segments that could have been recombined that we missed. This slide summarizes the 3 quantitative segment tests to determine which segments are material or individually reportable. I'm not going to read this to you now because we are going to walk through an example of each, but you might want to revisit this slide when you are working on your homework. Let's take a look at those examples. Okay, so for this example, we have Foley Corporation that has 7 industry segments with total revenues as shown below. Based on only the revenues test, which industry segments are reportable? Okay, so we have the 7 segments listed here, and we have the revenues that go along with each of those. So the first thing we're going to do is we're going to total up all of the revenues. So we get total revenues for all of the segments of $2,900. Then we're going to apply our materiality threshold, which is going to be 10%, and that's just the rule. You just need to remember that it is 10% of total revenues. So we are looking for any segment that has revenues that are greater than $290, and those are going to be considered material or reportable. All right, so we look at Penley. Penley has $600 in revenues. That's greater than our $290 threshold. So yes, this one is reportable. Same with Konomi. KSC, on the other hand, is 250. That's less than our threshold of 290. So this one is not significant or individually reportable under this test. Same with Red Moon, that is under our threshold. Chang is also under a threshold. I can't pronounce this one, so I just call it T. T is also under our threshold. And then Molina, 700 is greater than 290, so this one is reportable. So as you guys know, we have 3 of these tests we have to do. But if we only had one, we would now have 3 segments that we know need to be reported individually on our segment reporting footnote. So we have Penley, Konomi, and Molina. These other 4, KSC, Red Moon, Chang, and T, would be lumped together into an other line. So on GE, we didn't have an other line. They somehow managed to put everything into one of their segments, but some companies might have a smaller segment or several smaller segments that aren't material enough to be reported individually. All right, so we're going to actually skip the next tab, and we're going to go one more over, and we'll come back to that other example. So for this one, we have our same Foldy Corporation with their same segments, but now we're going to do the identifiable assets test. So again, this time we have all of our 7 segments. We have the identifiable assets that belong to each of those segments. First thing we're going to do is total those up. So we have total assets of $2,525. Our threshold is still 10%. So again, we just remember 10% is our threshold. That's just the rule. And then we're going to multiply our total assets by our threshold. And we get a $253 threshold. Anything greater than that is reportable or material for our segment footnote. Okay, so Penley, 500 is greater than 253, so that's reportable. Konomi, again, higher than the threshold. KSC just misses out with 250, that is below our threshold of 253. Red Moon has assets of 400, so that's a yes, they are significant. Chang is below our threshold, T is below our threshold, and Molina at 475 is above our threshold, so they would be considered reportable. So again, looking at just this test, again, we have 3 tests, but if we were only going to use this one, we would have 4 segments, Penley, Konomi, Red Moon, and Molina, that need to be reported individually, have their own line items in our segment reporting footnote, and then KSC, Chang, and T would all be lumped in together as other. All right, our last of the 3 tests is a little bit more difficult, so we're going to head back to that one. So that's the previous tab that we just skipped. So this is the profit or loss test. And so the profit or loss test, we can't do exactly the same as the others because notice we have negative numbers. So if we have segments that have profits and we have segments that have losses, and we just add them up together, our threshold is going to be artificially low. So instead what we're going to do is we are going to add up all of the segments that have profits. Actually, we'll just do it this way. So Penley, KSC, Red Moon, T, and Molina all had profits. So we're just taking everything with a positive number and adding it up together on the total profits line. Then we're going to add up any that have losses. So we have Konomi and Chang. Then we're going to pick whichever one, total profits or total losses, is bigger in terms of absolute value. So we have 349, and then the absolute value of our losses would be 60. So 349 is bigger than 60, so we're going to take our 349 and move forward with that. Then again, we're going to apply our 10% threshold. So our threshold here is going to be 35. So we head back up and we see Penley has profit of 90 and we're comparing that to our threshold of 35. So yes, they're reportable. And then again, we have to make sure we're looking at the absolute value. So for Konomi, they have a loss of 40, but we're going to say, okay, convert that to absolute value, so that's 40, and then compare it to our threshold. So 40 is greater than 35, so this is also reportable. KSC, 25 is less than 35, so they are not reportable. Red Moon, 50 is greater than 35, so they are reportable. Now again, remember we need to convert this to an absolute value. So we're going to compare 20 to our threshold of 35. That's lower, so we do not need to report Chang. T just misses our threshold. And then Molina is obviously above our threshold again. So here we have 4 segments meeting our profit or loss test and showing that they are reportable or significant. Okay, so if we head over to segments, this is where we're going to aggregate all of the results of those tests. So for revenues, we just click back here, we had Penley, Kenomi, and Molina were significant. So Penley, Kenomi, and Molina. Then for the profit and loss test, we had Penley, Kenomi, Red Moon, and Molina. So Penley, Kenomi, Red Moon, and Molina. And then for the assets test, we had the same 4 as the profit and loss test. Okay, so then we have to decide. We have to aggregate these 3 tests and figure out which ones we're going to disclose in our footnote as individual line items. And so for Penley and Kenomi, this is pretty obvious. They passed all the tests, so we are definitely going to include those. For KSC, that's also pretty obvious. They passed none of the tests, so they're not significant. But for Red Moon, they only passed 2 of the 3. So the rule here is if they pass any one of the 3, we are going to consider them to be material. So Red Moon also is significant. Chang and T passed none of our tests, so we're not worried about those. And Molina passed all 3, so that one is in. Okay, so remember we also have to make sure that with our 4 segments that we're going to disclose, Penley, Kenomi, Red Moon, and Molina, that when we add up their revenues, that's going to explain at least 75% of the total overall company's revenues. So we're just going to go grab their revenues from the revenue test. So Penley had revenues of 600. Kenomi had revenues of 650. We're going to skip KSC. Red Moon had revenues of 275. Going to skip Chang, skip T, and Molina had revenues of 700. So we're going to sum those guys up. And we get a total revenues of our reportable segments of $2,225. So we are going to take that amount and we are going to divide by total revenues of all the segments. So again, we're going to go back to our total revenues on our revenue test. And we get 77%. So that's greater than 75. So we're good on our coverage. Then we need to make sure we've gotten that coverage with 10 or fewer segments. So if we look up there and we just count how many segments we've decided we need to disclose, that's 4. 4 is less than 10, so we are good there. This concludes part 2 of our series on disclosure issues. Don't forget to email any questions you might have for our discussion.